I'm Edwin Warfield, the publisher of City Biz, and I'm honored today to interview Joe DaGrosa, who is the CEO and founder of Axxes Capital. Welcome, Joe.
Thanks so much, Edwin. Great to be here. Thank you.
Joe, you've had a fascinating career spanning private equity, sports, hospitality, and more. What originally drew you into the world of private investments, and what has kept you passionate about it?
Well, really a case of serendipity. I began my career a long time ago, 39 years ago at Paine Webber, which is now part of UBS, and spent 10 years there. And I covered one of the pioneering firms in what was back then called leverage buyouts, today sort of euphemistically called private equity. And one of the founders of that firm called InvestCorp, uh, one of the founders left, set up his own shop, and invited me to join him. So that was 29 years ago. So I moved from Wall Street to the exciting world of private investments, private equity in particular.
So, your new book, The Financial Advisor's Guide to Private Investors, talks about helping advisors lead in the next era of wealth management. What defines the next era and what will separate the leaders and the winners from the laggards?
Well, I think there's some very interesting things happening in the capital markets. On the public security side, we're going to 24/7 trading, for example, making the markets more efficient. But I think what we're seeing on the private market side is equally as interesting, in that the private markets are becoming more liquid and easier for the average investor to get into private investment opportunities. And, look, a great many people in this country, think school teachers or policemen, firemen, they've participated in defined benefit plans, large pension funds where, a handful of folks sitting in a room make very large asset allocation decisions, but they've been indirect beneficiaries of those decisions. But, the average person who runs their own business or, participates in a 401k defined contribution plan, they've not had the benefit of private investments. And so, I think we're seeing sort of pretty significant shift in terms of the opportunity set into private investments. And I think that's going to enable the average investor to participate and ultimately achieve better diversification and I believe better returns over the long term.
So, how do you see the traditional 60/40 portfolio model evolving over the next decade? And what replaces it in practice, not just theory?
Well, 60/40 is always going to be there, stocks and bonds. But, I think the private markets give one an opportunity to better diversify. And, Larry Fink at BlackRock's talking about 50/30/20 being the new 60/40, with the 20% being in privates. I remember, not to date myself too much, but, back in the 80s and early 90s, there was a firm called Ibbotson and Associates out of Chicago that was one of the pioneering firms in doing research. And, they came out with a study showing that if you reallocated your 100% US equity portfolio to 70% US and 30% international, you kind of achieve the holy grail of investing, which is better returns and lower volatility. And I think private markets investing, whether it's private equity, real estate, private credit, gives an investor an opportunity to reallocate, get better diversification and better returns. And I think that's what's so exciting about it.
So, what's the biggest misconception financial advisors or investors have about private investments today?
Well, I think the core question is one of suitability, and I think advisors run the gamut. I started life as a financial advisor. I had a book of clients, and my clients ran the gamut. And the way advisors approach their business run the gamut. Some are more aggressive than others. Some are far more conservative. And I think one of the misconceptions I think advisors have is that private investments are risky. And in point of fact, they can be, to the extent that advisors are promising or thinking that there is short-term liquidity opportunities in private investments. They're going to be disappointed and their clients are going to be disappointed. But for advisors who are thinking long-term for their clients, and look, the reality is a 50-year-old today is going to live 3.5 years longer than a 50-year-old of 30 years ago. And, the great news is, in terms of medicine and advancements in patient care, people are going to live longer. And that's wonderful news. The challenge, though, is that people may outlive their assets. And, if you have an investor who's got significant net worth, that's probably not an issue. But, the average American, yeah, it's a real issue. They may outlive their assets. So I think private investments properly positioned in a portfolio, because they are illiquid, although there are semi-liquid options out there like interval funds, which we're advocating and advancing. But nevertheless, there is that trade-off. But for folks who are thinking long-term, it's a trade-off that I believe is well worth it, because you'll be able to pick up about 1 to 300 basis points over, comparable publicly traded securities, whether we're talking about debt or equity. And, Edwin, we all know the magic of compounding. Over a year or two, it doesn't matter much, but over 20, 30, 40 years, that additional, 100 to 300 basis points compounded has a profound effect on the value of portfolios. It can make the difference between an okay quality of life for someone who hits their 80s and 90s versus an exceptional quality of life.
So, what role do you believe private market strategies like private equity, credit, and real assets should play in individual portfolios going forward?
Well, I think I think the way advisors view things and the way the average investor views things, certainly how I view things, is you have different buckets of money. You have money for the short term emergencies, clearly not suitable for privates. You have medium term, which is call it a 1 to 10 year horizon. Um, Maybe some exposure to privates is appropriate. But if you're talking about a long-term investment horizon, 10, 20, 30 years, I believe private investments should play a very important part in that portfolio composition.
So, Axis Capital is focused on expanding access to institutional quality investments for individual investors. Why is this democratization of private markets so important right now?
Well, I think it's important for some of the reasons we talked about, which is, there is, gosh, in the U.S., we've got almost 20 million accredited investor households. Depending upon the numbers, you're talking 80 to 90 trillion in AUM. We're right in the midst of a huge generational transfer of wealth. And I think private investments, now that they're becoming more and more accessible, can play a very important role in helping people secure their futures. That's what we're excited about. What our view is, advisors today, have a great opportunity to better serve their clients. Access to private markets really didn't exist 10 years ago for non-QP accounts. And by that, I mean, on the retail side, qualified purchasers, folks with 5 million or more. But when you think about the average advisor's book of business, 80% of the average advisor's book of business are accredited investors. And those are the investors that historically have not had access to private markets. And that is changing, and changing very rapidly.
So, what are some of the barriers that have historically kept individuals out of the private markets, and how is Access Capital helping break those down?
Well, we have a regulatory framework in the U.S. that's served us all very well. So I'm not criticizing the investment framework, but the cornerstone of the regulatory framework is the Investment Company Act of 1940, uh, popularly known as the 40 Act. And what the 40 Act essentially says is, if you're a sponsor, so long as you limit your investor base to QPs, qualified purchasers, institutions with 25 million or more, or individuals with 5 million or more, you can bring in an unlimited number of investors into your investment vehicle, into your private investment vehicle. Uh, the moment you bring in even a single non-QP account, you blow the exemption under the 40 Act, and you have to register. Up until very recently, meaning the past 3, 4 years, most private equity and credit shops, have really not had any real interest in going after the retail market, which, by the way, is the largest unmined pool of capital for the industry out there. But their focus has been on institutions. Retail has been sort of, one of those foreign concepts. How do you get into retail? It's distribution mechanics are far more complicated. So there really hasn't been a huge interest. It's only since, I don't want to call it the death of 60/40, because 60/40 is starting to come back now. But when 60/40 got punched in the stomach in 23, with both bonds and stocks delivering negative returns, you had the denominator effect, which meant that pension funds and the like found themselves over allocated to private equity and private credit. They shut the spigots off. And all of a sudden, a lot of firms that relied on that institutional capital to come in realized it wasn't coming in. So they started to think about, this massive retail market. And we started to think about it 3 or 4 years ago. And we said, look, that is the future of the business. Our view is, we want to help level set the playing field, particularly for accredited investors, not to the exclusion of other investors. But we think that accredited investor market deserves access, to great managers and opportunities for, better performance and lower volatility.
So, for financial advisors who want to start allocating to private investments, what's the best first step?
Well, I think the good news is, we're a big advocate of interval funds, and interval funds have a couple of unique advantages. In that, number one, you can get a CUSIP number, a ticker symbol. They appear on client statements. No subdocs, which is a game changer for the business. So, historically, most financial advisors know the pain of filling out subdocs, and there's firms out there like iCapital and Case that mitigate the pain of filling out subdocs. But the reality is, interval funds eliminate subdocs. The other big advantage of interval funds is you can dollar cost average. In the case of our funds, no particular fund, but in general, we have $25,000 minimums and $5,000 incremental investments, very similar to mutual funds. And I remember when I was an advisor, very hard to time the market. So, uh, myself and my team, we would dollar cost average. That is something that you can do with interval funds. You really can't do that with classic drawdown vehicles because the minimum investments are so high, and they're drawdown vehicles. So you never know when that capital is going to be put to work. So we think the interval fund construct is really the future of the business, and we're not alone in that view. I mean, recently Wells Fargo came out with a report. Morgan Stanley came out with a report talking about multi-trillions being reallocated from public securities into private investments through the interval fund structure. So we really believe it's the future of the business.
So, looking ahead, what excites you about where the private investment landscape is headed?
Well, I think what's most exciting is the 401k market. Um, when we started Access Capital, it was really a question of if that market would someday open up. And now we believe it's a question of when. President Trump has accelerated things by signing an executive order, putting pressure on the regulators to streamline the process for folks to be able to invest through their 401ks. I think that's probably 12 to 36 months out before we see, meaningful developments on the 401k side for private investments. But it's a question of when and not if. And that is, according to Barron's, they did a cover story probably about 3 months ago. It's a $12 trillion opportunity. And they pitch it as an opportunity for the industry. I view it through a slightly different prism. It's a $12 trillion opportunity for, literally millions of Americans who've been disenfranchised from being able to invest in private investments.
So, when you think about legacy, whether as an investor, leader, or mentor, what impact do you hope Access Capital will have on the industry and on people's financial lives?
Well, I think I'm more concerned, or I tend to think more about the impact on people's lives. I mean, at the end of the day, it's all about quality of life. And once again, on the good news is, medicine is going to help us live longer. The bad news is we may outlive our assets. So playing some small but hopefully meaningful role in making life a little bit better for folks down the road, that would be a wonderful legacy to leave behind from my perspective.
So, Joe, is there any part of your personal journey or your entrepreneurial journey that you'd like to share with us that you haven't shared with us in this interview?
Well, look, I've had an exciting career. I've described myself as the Forrest Gump of the capital markets because I tend to sort of wind up at the right place at the right time, mostly by sheer dumb luck. I think the biggest opportunity came when I was able to transition from Wall Street to private equity. That opened up a lot of doors for me. But I've been involved in sports. I got to own a soccer team in Europe, in Bordeaux. Uh, Very fortunate. We sold December of 19. 12 weeks later, COVID hit. So, and I'd like to say I saw that coming, but I could just as easily have been on on the other side of the trade, buying out other people. And so I've been very fortunate. I really have, and I've worked with some wonderful people. One of the deals that probably our most successful deal back in 2003 was the acquisition of Burger King's out of bankruptcy. And Edwin, I'll be honest with you, I was like the Maytag repairman. I had a fantastic management team. They executed flawlessly, and all I did was avoid getting in their way. And sometimes, the tendency is you want to be actively involved. And I think the key is getting, if you're able to partner with great managers, your job is to stay out of their way and let them do, what they do best, and support them as best you can. But I found that staying out of people's way has been a very successful strategy for me.
Well, Joe, I want to thank you for your time and thank you for sharing your story, and keep us apprised as you move forward, democratizing the access to private equity.
Thanks so much, Edwin. Really, really appreciate you taking time out to speak with me. Thank you.